Today, it takes more income to buy a home than at any other point in history. Home prices are at all-time highs, although they have come down a little bit since their peaks during COVID. Housing shortage is continually getting worse, and mortgage rates are the highest they've been in the last 20 years. So that begs the question, in today's market, is it cheaper to buy or to rent? And which option is going to save you the most amount of money in the long term? So I thought the best way to compare owning versus renting was to use a real-life example of similar units that are currently listed for sale and units listed for rent, and to go through the numbers for each using today's market conditions and rates, so that we could see firsthand the difference between the two in both the short and long term. What's up everyone, my name is Fady Nakhla. I'm a realtor here in Toronto. If you get any value at all from this type of content and you haven't already, hit that like button and subscribe to the channel. If you want to book an appointment with me, whether you're thinking about buying or renting, I have all my contact information in the description below, and I'd be more than happy to help. So first, let's talk about buying. When you buy a home, you're first gonna have to consider your down payment. In most situations, lenders require a deposit anywhere between 10 to 20% of the purchase price of the home. You can even get away with 5% if you're a first-time home buyer, but the average price of a home here in Toronto ends up being tens and thousands of dollars. Second, you'll also have to consider your mortgage interest rate. This is going to be your cost of borrowing money, and today that cost is going to be the highest that it's been in more than 20 years at just over 7%. Third, we have property taxes. In terms of how much this adds up to, it really depends on the city that you live in, but it's generally between 0.5% to 1% of the home's value, which again, with our average home prices today, ends up being several thousands on top of your existing payments. After that though, if you thought we were done, nope, because we then have home insurance. Home insurance is mandatory here in Ontario if you do have a mortgage, and the average homeowner pays around $2,000 per year for proper coverage. On top of that, if you're in a condo, you also have a monthly maintenance fee, or if you're in a home like a townhome or detached, it's recommended you budget anywhere between 1% to 2% of your property's value each and every year for repairs that will eventually come up for things such as your roof, windows, doors, things of that nature. Then you lastly have your general hydro, heat, and water bills, which generally range anywhere between $50 to $250 per month. So with all that information, here's how much it'll actually cost you to own the average home here in Toronto. We're going to use an actual example of a condo currently listed for sale in the city, and then compare that with a very similar unit currently listed for rent. So the average price of a condo downtown Toronto right now, as of November, is just under $740,000. So I found a unit listed for sale here in Fort York, which is just by Lakeshore and Bathurst. It's a 1+10, 1 bath, comes with parking, and is listed for $750,000, right around our average. Let's take a quick look at the unit just so you have an idea of what something like this looks like at that price point. So this condo at 20% down means you'd need upfront $150,000 for your down payment. You'd then be receiving a mortgage loan for the remaining $600,000, which at the current 5.5% interest rate brings your monthly payments to roughly $3,600 per month. From there, you're also going to have property taxes, which for this unit annually is $2,371 or $197 per month. Home insurance is likely to run you another $100 per month. Because you're in a condo, you also have your monthly maintenance fee, which for this unit is $620 per month. It includes water and heat, so you're only responsible for hydro separately, which let's say on average is about $100 per month. This brings your total out-of-pocket cost for an average price condo in Toronto to $4,579 per month, with $150,000 that you need to have saved up for the down payment. Now it doesn't stop there, because every month you make your mortgage payment, a portion of that payment pays down your loan balance. And in the first year at that 5.5% interest rate, that amounts to $11,607 or $967 per month. That means at $4,579 per month, once you account for the mortgage equity, you're left with a payment that's closer to $3,612 per month. But wait, you're still not done yet. Since you put down $150,000 down, you also have to account for the opportunity cost of that money. Since you're tying up $150K in a property that otherwise could have been invested elsewhere, let's say at an average of a 5% opportunity cost, that's $625 a month in investment income that you're foregoing for the sake of buying a property. That means when all is said and done, the true cost of owning this home when accounting for both mortgage equity that you're getting back and opportunity cost that you're losing is $4,237 a month. Now, the last factor we need to consider is long-term home appreciation. This one is obviously a little harder to analyze in the short term because just like we saw these last few years, depending on when you purchased a home or condo, you may be up 20% or you may be down 20% on the current value of your home. So this last factor assumes that you will be keeping your home long-term, I'd say minimum 5 years. And as you'll see in the next section when we talk about rent, we will compare both owning and renting long-term to see how both play out. But for the sake of talking appreciation, we will assume that your home will go up in value on average by 6% each and every year, which is a 50-year average here in Toronto. And for the purposes of our calculation, that would give you $45,000 for the first year or $3,750 per month. That means that the real cost of owning a $750,000 home net out of pocket after expenses, deductions, and after long-term appreciation is going to be about $487 per month. Now again, the key word here is long-term. You can't reliably use the long-term appreciation number in your calculation if you're only going to be in the home for 1 or 2 years. So in the short term, we're not going to include the appreciation factor of your home, so you're left with $4,237 per month. By the way, if you want to go through any of these numbers yourself, I'll leave a link to a copy of the spreadsheet in the description below. If you have any questions or are thinking about buying a property yourself, but would like to analyze the numbers first for any specific property, just like we're doing here, you can reach out to me using the contact information in the description below, and I'd be more than happy to help. Now let's talk about rent. Fortunately, this one is fairly easy. The price you pay is the price you pay. There's really nothing fancy about it. So now let's compare to a very similar unit in the area that is listed for rent and see what the numbers look like. So there's a very similar unit actually in the same building, 1+den, 1 bath, also with parking, currently listed for $26.50 per month. You have to pay tenant insurance, which does tend to be a little cheaper than homeowners insurance. So let's say $50 per month. And then you also have your hydro, which is still $100 per month. So the renting cost is $28.50 per month. Now, obviously in the short term, yes, renting is cheaper at $28.50 per month versus the $4,237 per month cost of owning your condo when you don't factor in property appreciation, because you technically can't use that money. It's equity in your home that you don't really see until you sell anyways. I mean, technically you can use it, but we'll discuss that another time. Now let's take it one step further and now factor in time. The average Canadian only stays in their home or moves every 10 years. That means we need to compare that timeline with the cost of renting and see what it looks like versus owning. So in our previous example, assuming the same $750,000 condo after 10 years of making mortgage payments, your mortgage balance would be down to $450,000, and at that 6% average appreciation, your condo value would be worth just about $1.35 million. That means that if you were to sell this home in 10 years, you would be left with just under $1.3 million after paying 5% in closing costs, of which $450,000 is your mortgage balance. And that leaves you with a cashback balance of just over $825,000. Now, of course, to come to that number, we are making some general assumptions that the property values are going to be rising over the next decade. And although we're using a 50-year average, which I think is pretty reliable, at the end of the day, you can never really be sure what's going to happen in the future with real estate. Now let's look at renting long-term over a 10-year span and what that looks like. So with renting, it's a little more tricky, especially when you start dealing with rent control. In Ontario, if your unit was built before November 2018, then it is rent controlled, meaning your landlord can only increase the rent once per year, and it can only be by a set percentage that the province decides every single year. But on average, it's been about 2.5%. If your unit is in a building that was built after that 2018 date, then it's not rent controlled, and your landlord can increase the rent still only once per year, but it can be by any reasonable amount. So in our example, this building was built in 2011, so it is rent controlled. So we'll go through those numbers, but just keep in mind that it can be much more than this. So I'd say this is the bare minimum in increases that you're going to see. So if we start at that $26.50 per month and go up 2.5% every year for 10 years, then our rent at that point will be just under $3,400 per month. So now let's put the numbers for owning versus renting side by side and see what you're left with at that 10-year mark. So for owning, you'll end up with a $1.35 million home, of which you owe the bank a remaining mortgage of $450,000. If you choose to sell, you'll receive about $825,000 in cash, or if you choose to continue with the mortgage of $450,000 at the current rate, your monthly mortgage payment will be $2,700 per month, down from the original $3,700 per month, and you'll still have that $825,000 of equity in your property. If you rent, you'll end up with a $3,400 per month rent, up from $2,650, and zero equity in the property. Remember, we did factor in opportunity costs though, so if you had invested your $150K in something else other than a down payment that yielded an average 5% per year, then after 10 years in the rent scenario, you would also have made just under $100,000. So what does this tell us? It tells us that renting is the cheaper option at today's prices if you don't intend to keep your home long term. Like we saw in our example, in that first year, when you did not account for appreciation, you're paying $2,850 per month on the rent side and $4,237 per month on the buyer side. I'd say selling anytime under 2 years from your purchase, and it's a complete gamble, and you could very well even lose money. If you don't intend to stay in a home long term, then it's likely that you're not going to be making your money back for closing costs, commissions, and all the other fees that come with selling a home. Now, on the other hand, if you do purchase a home for the long term, doesn't necessarily have to be 10 years, then I think financially it does make a lot of sense. And that's it for now, guys. If you have any questions about buying or even renting a home here in Toronto or the GTA, please don't hesitate to reach out to me using the contact information all in the description below, and I'd be more than happy to help. I'll see you guys on the next one.